Welcome back, ladies and gentlemen. Thank you all for checking out my video. Now, I put out a video last week and I just basically went over a couple of stocks that I was buying and things that I was looking into. One of those companies, if you couldn't already tell from the title of this video, was Foot Locker. And I don't know where exactly I stand with Foot Locker because honestly, on one hand, it's at a deep value right now in terms of the relative valuation. But on the other hand, there's a reason for it. So in today's video, we're going to dive into it, and without wasting any more time, let's get into this. Now, Foot Locker actually has quite a few brands that I had no clue existed underneath the parent company, but really what they have Foot Locker, Kids Foot Locker, Women's Foot Locker, but the Women's Foot Locker, they don't have as many stores. You got Champ Sports, East Bay, Atmos. They recently acquired Atmos and WSS, so those are some big ones, as well as Foot Action, which they're currently trying to sort of get rid of, and then Sidestep. And really, obviously, what the big key components of this company are going to be Foot Locker, Champs, and WSS. They're trying to push into new stores. We'll get that here in a second. But really, those are kind of the bigger players in all of this in terms of key drivers. Now, really what they do in general is, if you couldn't already tell from the name of the company, they sell sneakers and sort of street apparel. And really, it started off as shoes and sneakers and athletic shoes, and it's kind of ventured into apparel as they've grown bigger and bigger. And really, the big component of how they make their money is in-store, in-mall sales. So if you go to a mall, you'll see a Foot Locker store or a Women's Foot Locker, a Kids Foot Locker, a Champs. These are all really common stores that are within malls. And so what they're doing is they're selling sort of luxury athletic shoes, luxury streetwear, and they're able to make some money off of that. And what they're doing is they're buying shoes from brands, so say Adidas, Puma, Nike. Those are some of the brands that they own, as well as some others. And really, they're buying those and then selling them at MSRP, or maybe a little bit above, a little bit below, depending on what their sales are and what they're trying to push. Now, on top of selling in stores, they've recently, obviously a lot of companies have been pushing this way, but they've been trying to go a little DTC, direct to consumer, direct to customer. And really what that means is they're using sort of what they call omni-channel. So they're using their online website for you to be able to buy and it get delivered straight to your house. They're also doing in-store and in-store pickups, as well as just being able to order and get it directly to yourself, just in every sort of fashion you can imagine. They are now building themselves into. It started off with just in stores, but they've really ventured into online orders as well. Now, just a quick note on what the different brands are and kind of what they sell. Obviously, Foot Locker, Kids Foot Locker, and Women's Foot Locker, all of them sell sneakers and they sell athletic shoes as well as some apparel. Now, the average store size can vary depending on where in the mall it's located and what mall and what store they're using, but generally it's in the 1,000 to 2,000 square foot range. And then Champ Sports is more so athletic wear, and when I say athletic wear, I mean think of like jerseys for baseball, football, soccer. They also have hats and just different other sports memorabilia. WSS is just shoes, but it's more of like a all-inclusive store in terms of they have women's, men's, and kids all together in one store. Generally speaking, WSS is off mall, or at least it's not within the mall. It might be on the mall premises somewhere, but it's going to be the off mall store that you go into. It's going to be a little bit bigger, and that is one of the best things that they wanted, is they wanted that opportunity to be able to diversify. Just when you go to get shoes, if you go to WSS versus going into Foot Locker, what your expectations and what you can actually get there. Now, Sidestep focuses on Germany, Luxembourg, Netherlands, Belgium, and some of the other countries within that region. And really what it is just sort of a foot apparel, footwear store, and it's just specifically made for those European regions. I don't believe that we have any here in the States. And then East Bay focuses on getting high schools and other athletic teams just sort of athletic wear or footwear, whatever it might be. They're kind of a one-stop shop for these options. And then Atmos is more of a digitally driven Japanese brand, and they sell shoes and sneakers just as well as the other stores. So you can imagine under Foot Locker, it's mostly focused on shoes, as you can tell by the name, but that really is the business model and how they sell their shoes. Now, if you could imagine going into the segments and how they break this down, just over the last 2021, really from end of 2020 into 2021, we had a lot of stimulus. We had a lot of different things come out in terms of tax refunds and just other big ticket items that people were able to get money back into their account. And then obviously you weren't able to spend that money due to the pandemic. You weren't able to spend that money on experiences or anything like that, at least at the first half of 2021. So a lot of people went and bought shoes and other, material goods. And so really that is why this company has had such a record year. And this is the highest that this company has ever hit in terms of their sales. They hit almost $9 billion. And then of that $9 billion, about 9% of that turned into net profit. So really they're driving these sales through into the net profit, and a lot of it's just due to the fact that there was a lot of stimulus there. So they had just shy of, I think, $900 million in profits. So that's a really good year, and you're going to see why and what they did with that money here in a second. But just know that when you're looking at this and you're comparing 2021 to 2020, even to 2019, this year was a record year, and they expect a different outlook. Now, as far as the segments go, really a bulk of those sales came from the in-store sales. So about $7 billion came from in-stores, and then almost $2 billion came from sort of the direct-to-consumer method. So really, when you're focusing on this, I like to look at the direct-to-consumer because you don't have to pay for the stores, you have to pay to hold the inventory, and they're actually moving to do more of a drop ship kind of model rather than holding inventory. They just let whoever the supplier is automatically send it to the client or customer rather than them needing to be sort of the intermediary. And then obviously, not surprising, the United States makes up a bulk of these sales. We have about $6.5 billion worth of sales, and then the rest of the international community. So that's about 28 other countries makes about $2.5 billion. So again, it's not surprising that the United States makes up the most of this because it's a United States brand. But on top of that, we really do like footwear here, and we really do like athletic footwear, like basketball shoes and soccer shoes a lot. So it's not really that surprising when you look at it. Now, one of the things that I wanted to mention was the financials. Let's dive right into the financials. So now starting off, going in, the sales are about, as I mentioned, $8.96 billion. And one thing I also want to mention is that because they acquired Atmos and WSS, that's not all organic growth. That's not all the organic business growth. Part of that comes from the fact that they acquired and now they get the sales from Atmos and they get the sales from WSS. So that is something I want you guys to pay attention to, because as we grow this company and as this company grows, you need to look at comparable store sales and what that actually means to the rest of the business rather than just the general revenue. Because I wouldn't be surprised over the next couple of years, this company keeps acquiring businesses and keeps acquiring apparel companies or footwear companies to try to broaden their market and try to get into more space and more stores. They're changing all the Foot Action stores into Foot Locker banner stores. So it's not going to be surprising if they do something similar with other companies as they try to engage into more and more markets. So going forward though, their net profit again was around 9%. And of that 9%, we usually generally before the pandemic happened, saw a profit margin of around 4 to 7% was really what I was seeing. It seems to bounce, and generally it's all consumer spending related because again, these are luxury shoes for the most part. I mean, these are pretty expensive shoes. So if a credit crunch or something happens for a consumer, they're not going to go out and buy Foot, or they shouldn't. Rather, I'm sure some people do, but they shouldn't go out and buy these shoes because they're very expensive shoes. So I just wanted to point that one out. Now, as far as their valuation goes and just sort of where that goes and ties into all their financials, Their PE currently is at about a 3.5 to a 4, depending on where you're looking. And the forward PE is around a 7 to an 8, depending where you're looking. And really what that means to me is that they expect earnings to really drop significantly. And again, this is a record year, so it's not that surprising to think that maybe in the future there's going to be a drop in earnings, for at least in the short term, 1 to 2 years, as everything sort of settles back down, because we don't have the stimulus anymore. And again, your comps for the year for 2022, really compared to 2021, we don't have stimulus in 2022. The tax refunds won't be as huge as they were, so we'll see realistically what the comps look like, but I don't think that they're going to be that favorable. But you just have to know that going forward that we had a crazy year in 2021, so it's not that surprising if 2022 doesn't live up to 2021. So their enterprise value to EBITDA was around 4.5. Their current cash on the balance sheet is around 804 million, and then obviously their inventory, they bumped it up for some reason. I wonder if this comes down to WSS and Atmos having a lot of inventory on hand, or them just trying to stack their inventory for the year, or what exactly happened. But their inventory is about 1.266 billion. I believe this is around 37% of the same, increase from the same quarter last year. And then of that, I don't know how much is going to be, held throughout the year versus how much is actually going to be turned over. We'll see. It all kind of depends on how their sales go. Now, going back to this, the debt is around $457 million. They took out a note that is due in 2029. I just want to point out one thing, is that I have a feeling that they're going to financially engineer, and you're going to see why here in a second, and how the repurchases and all that work. But I have a feeling that we're going to see some financial engineering. So I wouldn't be surprised if that's what that note really was for. Because again, they've done repurchases and they're doing dividends, and here I'll touch on here in a second. But their lease obligations was around $2 billion. Obviously, they're going to add to those lease obligations as they keep building out more companies and building out more stores. But one of the best things is that they actually have better control of their leases, because they took shorter terms on their leases. So that means that they can close stores when needed. They can liquidate the inventory, or at least move the inventory around with no real issues going forward. So I think that was one of the smart things that the company came up with, and that management has been pivoting to. So the last thing that I wanted to touch on for the financials, and I'll pop it up here, I was looking through their 10K and really just trying to get an understanding of their financing and how all this worked. And one of the things that I noticed was that they had a free cash flow, what they calculated, this is from their 10K, they had a free cash flow of $457 million. Of that $457 million, they paid out about $449 million of that. So $449 million was paid out, and about 348 of that was used for repurchases, and then 100 million of that was used for dividends. So they're paying out nearly all of their free cash, at least for 2021. But if you look back at 2019, it was almost the same exact thing. So I hope that we're not going to be looking at some more financial engineering going forward. I would prefer that the company took that free cash and use it to buy something for the company and build the company out better. But again, I get if they're trying to, better their stock for the shareholders. But I just, it's one of those things where I feel like you should focus on the business and not so much the stock price, because if your business grows, stock price usually follows. But going forward, just know that they're financially engineering possibly. Just pay attention to it as the reports keep coming out, as the SEC filings keep getting made for the 10Qs and 10Ks. And just watch this number, because I have a feeling that this is going to keep going, or if they keep adding debt, try to figure out why that debt's being added. I think in this case, the debt was added to really cover a lot of this and make sure that they had cash on the balance sheet. Because they are only at 800 million. So if you think about it, they had 457 million come in from the debt. They would have had half of the 800 million had they not added that debt. Now, going into the industry, you guys have probably seen me pull this report before. I'm just going to read it straight off of the line. McKinsey.com actually had a whole item, and I used this in my Nordstrom video, and I felt like this was kind of relevant here too. So again, travel had traditionally been a key driver of luxury spending, but international tourism is not expected to fully recover until 2023 to 2024. Also, the recovery will be uneven between all the retailers and ongoing supply issues. Many of the companies we are Many of the companies are having employee retainment issues on both the corporate and retail side of the business. Now they did note that social shopping and surge of social media use allows brands to connect to consumers on an intimate level. McKinsey recommends that companies should double down on integrating their online shops with users' phones and apps in mind, so that they can build out data to find what their customers actually want. Lastly, I would like to point out that over the last year and a half, we have a lot of free money due to stimulus checks and deferment of student loan payments. This gave many consumers a lot of free money to spend on whatever they wanted. While I do think that people will still buy at retailer stores, it is important to watch consumers' money supply and how much they have to spend on products. Part of this also comes from looking at the amount of credit that consumers are using. Now, I used that for the Nordstrom video, and I feel like it's still relevant here because, again, the majority of the money is being made at malls, or at least stores that are in malls. They're trying to diversify away from that and trying to get into different kinds of stores that are off mall premises. But as far as their current business and what we're evaluating, a lot of it's in malls, and I really do think that that's a point that we want to make. The industry does look like it's going to grow. It's not going to grow a ton. I mean, the footwear industry as a whole is pretty large, but Grandview Research actually had a whole entire report talking about this, and they said that the global athletic footwear, and again, this is just athletic footwear, so they sell more than things that would be classified as athletic footwear, but from what I saw, it was around the same CAGR going forward. But I just want to point this out because a lot of what they're going to be selling and the exclusive items that they have at Foot Locker are going to be basketball shoes and other sorts of athletic based shoes. But Grandview Research found that the global athletic footwear market size was valued at $127 billion in 2021 and is expected to expand at a compounded annual growth rate of about 4.9%. And again, I found that overall we're going to see some sort of growth in this. It could be 4.9%, could be 3.7%, whatever it's going to be. It's not going to be a ton. It's kind of the driving point. And I think that overall we're going to see as they diversify their mix, you'll see maybe a push into a different direction. One of the things that they're trying to do right now is integrate more apparel, and they're doing that online and they're doing that in stores. And really, they're trying to bring in their own brands of apparel as well as, Nike, Adidas, Reebok, and those kinds of brands. So I think the more that they can mix their private branded in, and I mean, it's going to end up being a higher margin for the most part if they can get their own brands in and be able to, drive that forward. Because at the end of the day, they need to be able to control their ship. Right now, they're just reselling shoes, really. That's really what Foot Locker is. They're buying them in wholesale and reselling them to users. Now, they do have exclusive deals on some shoes, like LaMelo's shoe. But if Nike is going to, move some sales around, or Adidas or Reebok's going to move sales around, it'll affect the business. So I just wanted to touch on a couple strengths, and then we're going to hop right into the risks, and then we'll do a little discounted cash flow, and then we can finish out the video. So first thing that I wanted to point out strengths-wise as far as the business goes, they're going to be repurchasing $1.2 billion worth of their shares. $1.2 billion worth. That's a lot. Their current market cap is at $3 billion. So they're going to be repurchasing around 40% of their shares, or repurchasing 40% of their market cap, rather. And that could possibly double the stock, triple the stock, depending on, the existential circumstances from the company. But that could, boost the stock price at the very least a ton. And $1.2 billion, obviously it's not going to be done over 1 year. It'll probably be done over a few years, maybe 3 to 5 years. But they've given the okay to $1.2 billion. And then the other thing that I wanted to point out, as far as the repurchasing goes, they repurchased 7.5 million of their shares, so that'll be about $348 million in 2021. And that's what I think going forward, they'll probably be close to 300 million, 250 million each year. So it'll probably take a few years for them to actually go through $1.2 billion worth of repurchases. And likely they'll just do it when they think that the market price is lower than the company's valuation of themselves is. But as far as the repurchasing of shares, this is the financial engineer I'm telling you about. Watch them issue more debt. If they do start issuing a ton more debt, might not be the financial security you've been looking for in a company. Totally understand. I'm not personally going to get into this company just strictly for the repurchasing. I need the business to do well. The repurchasing is one thing, but there's no guarantees in life, so we'll have to see. Now, the next thing I want to touch on was reinstating the dividend. They had a dividend in 2019. COVID happened. They stopped paying out the dividend, and they reinstated it. Right now, it was at 40 cents per share, and that was about 30% higher than what it was before. But what they're going to do is reinstate it and review it on a quarterly basis. So, with this company, there's no guarantee you're going to get a dividend in next quarter and the quarter after that and quarter after that. I think that they would like to get to that point as the business stabilizes and as just the economy stabilizes as a whole. But I think that if you're going into this strictly for the dividend, this might not be here. The company was paying a nice dividend before, don't get me wrong, but I think that you just need to be wary of, if you're buying this company, you buy it for the value. Don't buy it for the dividend. Think of the dividend as sort of an extra bonus on top of that, along with the repurchases. And then the third strength, and one of the things I wanted to point out, was their strategy and what they've highlighted. They really want to build out their technology, and they want to build out their R&D and things, so that way they're able to use data-driven strategies and actually go to market with data through both their in-stores and online channels. And they're really just trying to build their channels in general. But they're trying to, do a two-pronged approach with the online and the in-stores, as well as adding to more off-mall stores. So what I mean by that is they're building out sort of just all around athletic stores, all around outdoor type stores. And we're going to be probably seeing that this year into 2023. So be on the lookout for that. See how that fits your sort of thoughts and fundamentals of this company as far as how you feel about it. But they're trying their best to build and diversify away from just relying on malls and relying on stores that are in the mall. Because again, a lot of people think that the malls are dying. A lot of people don't want to go to the malls, especially after the pandemic. People are probably more wary to go into a mall because they think they might get sick. That's just something that you should think about as far as a macro level view. Look into malls and think if you're comfortable with that. And then you can decide from there when you do your own DD. Now, as far as risks go, the first thing that I wanted to point out was just something that they had mentioned. And I feel like this is kind of important because it came from their 10K, and I couldn't get over this fact. So in addition, all of our significant suppliers operate retail stores, distribute products directly through the internet, and others may follow. Should this continue to occur or accelerate, if our customers decide to purchase directly from that brand or their suppliers, it could obviously hurt Foot Locker. And this is something that I wanted to point out because Nike is moving towards more of a direct-to-consumer. Adidas is going to move more towards direct-to-consumer. So if Foot Locker doesn't control the end product, it's going to be pretty hard for them to make any sort of moves unless they can get exclusive deals. And in that case, they're going to be paying a lot just to keep that exclusive deal exclusive, really, and not have Adidas, not have Nike sell their own shoes through their own websites. Obviously, in case of Nike, it's in Nike's favor to sell through their own website, because then A, they control their brand end to end. B, they also have a higher margin on that because they're not wholesaling it. They're just selling it from their own warehouse, their own inventory, out to the consumer. Obviously, there's logistics costs and things that go into shipping it and all of that. But as far as having to worry about wholesaling it, they don't really need to. And then if they need to pivot, they can take the inventory that they don't need, put it on sale or whatever, and get rid of it rather than wholesaling it to another company, and the company either overbought or underbought, and they have to worry about that extra supply chain sort of tier as far as selling goes. So it'll be interesting to see how Nike plays this out, but that's actually my second risk that I had put here. So they had pointed out in their mix for earnings and then just going forward in 2023, Nike made up about 70 to 75% of the sales within 2020. And then in 2021, they're about 65, and they expect that to decrease to 55%. It'll probably be around 50 to 55% of sales is going to be Nike. So first off, Nike makes up a humongous chunk of their sales. That is number one. So if Nike decides to go direct to consumer, which they're accelerating that, that's going to be an issue. Number two, they're actually decelerating, using Foot Locker as a way for them to sell their apparel and sell their shoes. So that's not going to be good for Foot Locker, who now has to deal with the fact that they're going to be competing against their own supplier, which could be kind of interesting. I don't know exactly how that's going to work out, but it seems like Foot Locker and Nike still maintain a good, strong relationship. But I think Nike's acceleration into direct consumer will be something that you need to watch. So if you're going to look into Foot Locker, you might want to look into these suppliers. If they're public, look into their SEC filings and see what they're doing, or their earnings releases, to see what the management's planning on doing, because that'll give you a telltale sign of where Foot Locker sort of is in this food chain in terms of direct-to-consumer and in-store sales. Because Nike has their own stores and Nike has their own direct-to-consumer channels, so it'll be interesting to see going forward. But it is definitely one of the biggest risks that I think for the overall business model in terms of how Foot Locker makes its money. Now, the last thing that I wanted to point out before we dive into the DCF is their outlook for 2022. So they expect their sales to be down 4 to 6%, and they expect their comparable sales, so their comps sales, to be 8 to 10% down. Both of those are pretty far down from 2021. But obviously, you're comparing to 2021, which was a record year. You're not going to get the stimulus and tax refunds and all that stuff again, at least not from what we know right now. Who knows? But realistically, what that means is that we're going to see some huge sales declines. And if they can't keep up with these sales as far as adding acquisitions, the organic growth of the business isn't growing. The comparable sales growth isn't growing. That's where we want to pay attention. One other thing I wanted to point out, because they mentioned it, a lot of the sales they did in 2021 weren't, they didn't have any sort of markdown. So, when you go to buy something and there's a coupon or whatever, they didn't have a lot of that in their sales. So their gross margin was at 34%, give or take, and they were able to pretty much sell things at full price. They don't expect that that's going to happen this year. Again, people don't have stimulus. They have probably a little bit more inventory fluctuation and flexibility that they can handle now, versus before they couldn't just, they only had a set amount of shoes and everything was backed up in LA in the Long Beach ports. So they couldn't just, put things on sale and replenish them immediately. So that is something you want to watch too in terms of their margins. So that'll hurt net earnings and the gross profit margin also, obviously. And I would just pay attention to that as time goes forward. So the last thing that I want to talk about before we get to closing thoughts is the DCF. So I'm not going to go through all this in depth, crazy amount. Obviously, you have your current outstanding shares, you got your revenue, you got your current free cash flow, and you got your net income. Their current PE, again, was around 3, and their price to free cash flow is around 6.5. And then their current market cap as of making this video was about $3 billion. Now, what I want to point out is that I use the revenue growth of -2%, -1%, and 0%. And what I mean by -2% is it's an average. So you can have, the next couple of years, it's -2, -3, -4. Then after that, it's probably, 1, 2, 3, 4, 5%, whatever it may be. This is over a 7-year period. So add a couple of years where it's going to be super negative, add a couple of years where it's going to be positive. I think that this is going to average out about -2%. I use a profit margin of 3% for the lowest case, and then PE and price free cash flow ratio of 8. As far as the mid, I do -1% and then a 4% margin for the profit margin, free cash flow margin, and then a high, I did 0%. So that means the revenue doesn't grow at all. And then a profit margin and price free cash flow margin, or free cash flow margin of 5%. Again, their net income margin was around 4 to 7%, depending on the year you're looking at. But I just tried to get in the middle towards the bottom end of that range. The discount rate I use is 12.5%, and then obviously the fair value that I've calculated is going to take a probability of all 3 scenarios. So I really do think that the lowest case scenario, but it's going to be either below the lowest case scenario or in between the low and the mid. So combining all of those, you get a $31.57 fair value. If you look it back up at the top, the net income is the lowest, or in terms of the worst case, is $28. And the best case, it's $53. So that's a pretty huge swing either way. And that's why you have to add a margin of safety to this, and you have to really look into this and understand the business why. I don't think I understand it well enough just quite yet. I need to look at the other brands that are technically their suppliers. But in terms of a 20% margin of safety, I think a buy-in price, for me at least, may be around $25. If I can become more comfortable with Nike and other brands and how they're selling, and if they're actually moving towards that DTC model, that margin of safety might need to be even higher. So my buy-in price may be even towards $20, $22. But as far as what I'm looking at, this is my DD. This is what I've come up with. $25 may be something I might look into. Now, as far as some closing thoughts and things that I wanted to end on with, there's 3 things I want to touch on. Valuation-wise, I think that this company's probably more so at fair value than undervalued or deep value, however you want to put this. And that's not taking in the shares changing into effect. I just looking at the current valuation and discounting it out certain 7 years. I think that $25 for me might be more of a buy-in price, maybe $22, $20. Obviously, as it gets lower, your margin of safety gets bigger. That's really what I want. But as far as the business model goes, I'm worried about Nike. I'm worried about Nike. I'm worried about the other brands as well. Because the thing is, if they're going to have to sort of get exclusive deals and exclusive access to shoes, that's going to be more of an issue going forward, because if Nike goes more direct to consumer and so does Adidas, and they have higher margin, they have better control of their brand end to end, and they don't have to worry about someone like Foot Locker tarnishing one of their shoes or messing something up that ends up hurting Nike or another brand in the end. So I think that companies probably like that better, that they can control everything, as well as Nike has stores and Nike has online shopping. So it's more so like they're competing with their own supplier on sort of the same thing. So maybe the answer is to get more exclusive things to their store that Nike's not selling through their own channels, and that might end up being the solution, at least in the short term. But over the long term, I think that they need to get into more private or just their own branded items that will sell as well. Because if they can get at least like an apparel line or something that will sell along with the shoes that they're selling for other brands, I think that overall that will help the company as far as margins go, because they just need to be able to control their own product. Right now, they're selling shoes based on what they see as far as demanding and forecasting and estimating what kind of shoes are going to be in now and what kind of shoes they can offer. Obviously, they have exclusive deals with different basketball players and other athletic or athletes. So it's not surprising that we're going to start seeing those things come out, but it's dictated by the brand. So Reebok, might not like Foot Locker to have exclusive access to X shoe, or Nike might not like that either. So as far as this business, I'm going to stay away from this for now. I don't like the mall-based approach. I like the online e-commerce side, but it's hard to do that with shoes. So I understand that, but as far as valuation and the business model, I'm going to stay away from it. I do think that repurchasing the shares may be something that will help someone who holds this company currently, because it's almost 40% of their market cap currently. So obviously, if you're going to take 40% of the market cap off of the stock market, that's going to probably drive the price a lot higher. But it is something that you should pay attention to. But anyways, guys, I hope y'all had a great time. I hope y'all liked the video. If you have any suggestions for companies, leave a comment down below, and I'll see if I can look into it if I understand if it's in my circle of competence. But as far as this company goes, I understand shoes. I understand how shoes get sold. It's not a very hard business, but I think that the business model may be something you're not interested in. It's at least something I'm not interested in at the current valuations. But with that being said, I hope y'all had a great day. I hope y'all get to see you in the next video. Have a good one. Peace.